Amazon started as an online bookstore in a garage. Today, it's a $2 trillion company reporting over $700 billion in annual revenue. But here's what most investors still get wrong. Amazon is not a retail company. And once you understand what Amazon actually is, the investment case looks completely different. Let's break it down. Most people think Amazon equals shopping. That's like saying Apple equals phone cases. Amazon runs three distinct businesses inside one stock. 1. Retail, North America and international e-commerce, third-party marketplace, Prime subscriptions, physical stores like Whole Foods. This is what everyone sees. It's massive, but margins are thin, sitting in the mid-single digits. 2. AWS, Amazon Web Services, the world's largest cloud computing platform. This is the engine. AWS represents roughly 17% of Amazon's total revenue, but generates the overwhelming majority of its profit. In Q4 2025 alone, AWS produced $35.6 billion in revenue, growing 24% year over year, with an order backlog of $244 billion locked in. 3. Advertising. This is the hidden gem most people forget about. Amazon's ad business hit over $17 billion in a single quarter, growing 22% year over year, making it the third largest digital advertising platform in the world behind Google and Meta. And it's still accelerating. Understanding this split is everything. Retail drives the revenue. AWS and advertising drive the profits. The scale here is almost hard to comprehend. Full year 2025 revenue crossed $716 billion. Operating income hit $68.6 billion, up 86% from the prior year. That's not a typo. Operating income nearly doubled in 1 year. Q4 2025 was a landmark quarter. $213.4 billion in revenue, beating Wall Street estimates. AWS accelerated to 24% growth. Net income came in at $21.2 billion. Then Q1 2026 kept the momentum going. Worldwide revenue of $181.5 billion, up 17% year over year. AWS re-accelerated again, this time to 28% growth, its fastest pace in 15 quarters. AWS is now a $150 billion annualized run rate business, and advertising hit $17.2 billion for the quarter, up 22%. Analysts project 2026 total revenue at $807 billion. Amazon is becoming one of the first companies in history on a path toward a $1 trillion revenue year. Here's why the bulls are so fired up right now. 1. AWS is re-accelerating, not slowing. After a brief growth slowdown in 2023, AWS has come roaring back. AI workloads are flooding into the cloud. Every company building AI products needs compute. Amazon is making a $200 billion bet in 2026 on infrastructure, data centers, power capacity, and custom chips to capture that demand. Critically, CEO Andy Jassy said that over $100 billion of commitments from major customers, including OpenAI, are already locked in. This is not a speculative build. It's demand-driven. 2. Custom silicon. Amazon's Trainium chips are a $10 billion plus business growing at triple-digit percentages. If Amazon reduces its dependency on NVIDIA and captures more of its own AI compute margin, that's a structural improvement that most models don't fully price in. 3. Advertising flywheel. Amazon's ad business has an unfair advantage: intent-based targeting. When someone searches on Amazon, they are ready to buy. That's a higher quality signal than almost any other platform. An $80 billion annualized advertising business at 20+% growth is one of the most underappreciated assets in big tech. 4. The $244 billion cloud backlog. That's committed future revenue, already on the books. Not projected, not hoped for. Contracted. That's one of the most powerful forward revenue visibility positions of any company in the world. Now here are the real risks, and they're worth taking seriously. The $200 billion capex problem. Amazon just announced it will spend $200 billion on infrastructure in 2026, up from $131 billion in 2025. That level of spending is compressing free cash flow dramatically. Free cash flow fell nearly 66% year over year as capex surged. The bear case is simple. What if the revenue from all this spending takes longer to show up than expected? If free cash flow stays suppressed past 2027, the margin expansion thesis breaks down. Tariffs and retail pressure. Amazon CEO Andy Jassy has publicly acknowledged that tariffs are feeding through to product prices. The elimination of the de minimis rule, which used to allow low-value overseas packages in with minimal customs friction, has raised costs on the third-party marketplace. In a retail business with thin margins, a 10% cost increase has almost nowhere to go. Cloud competition. Azure grew faster than AWS in several recent quarters. Google Cloud is gaining enterprise ground. Both Microsoft and Google are deeply embedded in AI with competing platforms. AWS's moat is real, but it is being pressured harder than at any point in its history. Valuation. At roughly 30 times forward earnings, Amazon isn't expensive by tech standards, but it's not cheap either. Any miss on AWS growth below 20% or another quarter of compressed operating guidance could knock 15% off the stock fast. So where does that leave you as an investor? Amazon is not one story, it's three businesses in one stock at three very different stages of maturity. Retail is the flywheel that drives Prime loyalty and ad dollars. AWS is the crown jewel compounding at scale. Advertising is the overlooked profit engine that most people walk right past. The bull case. AWS sustains 24+% growth through 2026. The $200 billion capex starts monetizing. Advertising hits $80 billion annualized, and the stock pushes toward $300 and beyond. Wells Fargo already has a $300 target. The street consensus sits at $281. The bear case. Capex runs ahead of monetization. Retail margins compress under tariff pressure. AWS growth slips below 20%. And the stock retraces toward the low 200s while investors wait for clarity. Of all the Magnificent Seven, Amazon may be the most straightforward long-term hold because the AWS and advertising flywheels are structurally compounding, and the retail business gives you an option on every new consumer technology Amazon deploys. From Alexa AI to drone delivery to Project Piper satellite internet. The short term is cloudy. The long-term picture is one of the clearest in the market. Jeff Bezos once said, Amazon is always on day one. After $700 billion in revenue and a $2 trillion market cap, somehow that still feels true. This is not financial advice. Do your own due diligence. Drop a like if this helped you think more clearly about Amazon, subscribe for more deep dives, and tell me in the comments, do you own AMZN, and what's your price target? And that's a wrap on today's video. If you stuck around to the end, you're already ahead of most people. Seriously. The fact that you're here, learning, putting in the work, that matters. The market will open again tomorrow. The question is, will you be ready? Stay covered, stay strategic, let your money fly. Everything shared on this channel is for educational and entertainment purposes only. I am not a financial advisor, and nothing you hear or see here should be taken as financial advice. Always do your own research and consult a licensed professional before making any investment decisions.